Hello everyone and welcome to the episode 9 of Circus and Circuit Unraveling Global Trade. I'm your host, Kate Foronda, and today I will address a topic that is reshaping the entire landscape of global commerce: sustainability in commodity trading. Now, sustainability might sound like a buzzword you see in marketing desks or social responsibility reports, but in a world of international trade, it is fast becoming a non-negotiable business factor. From petroleum to palm oil, from copper to corn, the way we extract, process, and transport raw materials is under growing scrutiny from governments, investors, and even end consumers. The stakes are high. And not just environmentally, but financially and reputationally. With that, in today's episode, we are going to unpack what sustainability really means in the context of commodities, why pressure from regulators, buyers, and capital markets is reshaping how trade operates, some recent cases that present the shift in action, and finally, what you as a trader, investor, supplier, or company lender can do to move forward strategically. Let's begin. Sustainability in commodity trading isn't just about reducing emissions, although that is a big piece of the puzzle. It's about ensuring that the entire life cycle of traded goods, from source to ship to shell, is accountable, ethical, and future-proof. Let me start with the basics. It will be a bit of lecture now. The traditional commodity value chain has always focused on three things: price, volume, and logistics. But now we are adding a fourth dimension: impact. And that impact is evaluated through ESG lens: environmental, social, and governance. Environmental. It means considering carbon emission, water usage, deforestation, and waste generation. If you are trading coal, for example, your product is already under pressure from clean energy targets. But even agriculture now faces heat. Soy and beef traders have to prove they are not contributing to illegal land clearing, especially in areas like the Amazon. Social. Social involves labor conditions, human rights, and community impact. Cobalt mining in the Democratic Republic of Congo is a high-profile example where major tech firms have been accused in turning a blind eye to child labor in their supply chain. Now, commodity traders are being asked to audit those sources and work only with certified and monitored producers. And finally, governance. Governance refers to the transparency and ethics of the trade itself. Are your deals documented? Are your logistics providers compliant? Are you avoiding sanctioned counterparties? These aren't just compliance issues. They are now part of how your company is scored in terms of ESG readiness. And it's matter. According to McKinsey's 2024 Global Trade and Sustainability Report, over 85% of institutional investors now consider ESG performance as a factor in trade finance approvals. In other words, if you can't prove your sustainability record, you may not get funded. Let's not forget about reputational cost. One scandal, say your cotton shipments is traced to forced labor, can lock you out of the market. The US Custom and Border Protection detained over, and this is important, attention please, over 5,300 shipments in 2024 under the Forced Labor Prevention Act. It's 67% increase from 2023. So to sum up here, sustainability is no longer a soft goal. It's structural, strategic, and here to stay. Whether you are sourcing palm oil from Indonesia, bauxite from Guinea, or gas from Qatar, you need to think not only about cost and compliance, but also about your environmental footprint, social accountability, and governance integrity. Now let's discuss a pressure because it's coming from every direction. In July 2024, the European Union officially launched the Carbon Border Adjustment Mechanism, or CBAM. This is a game changer. The CBAM applies carbon pricing to imported goods like steel, cement, aluminum, and fertilizers. So, if you are a trader exporting to the EU and your goods were produced with high emissions, you will pay a carbon tariff. And this is just a start. The EU's deforestation-free products regulation also kicked in this year. This requires importers of soy, palm oil, cocoa, timber, and coffee to prove their products are not linked to deforestation, even if that deforestation was legal in the country of origin. In the US, the SEC finalized rules in March 2025 requiring public companies to disclose climate-related risks and emissions. If you are part of their supply chain, you are next. And many smaller firms are voluntarily aligning these regulations in anticipation of global harmonization. Another pressure is from buyers. Buyers, especially large corporations, are imposing their own ESG standards. For example, in March 2025, Nestlé updated its supplier code. Now, all agriculture commodity suppliers must provide their data and third-party verification of their environmental practices. Similarly, BMW and Tesla have both signed binding ESG clauses with their lithium and cobalt suppliers. These clauses cover not only environmental impact, but also labor practices and community consultation rights. With that, even if you are not facing government sanctions, you may find yourself squeezing out by your own clients if you can't meet their ESG benchmarks. Another pressure comes from capital markets and finance. The cost of capital is now ESG sensitive. Companies with poor ESG scores may pay between 0.75 to 1.5% higher interest rates on average, according to S&P Global's 2024 ESG risk study. Trade finance providers, especially in Europe, have started requiring sustainability-linked documentations before issuing letter of credit or performance bond. In short, your financing may hinge not on price but on proof. And investors are walking away from companies with poor ESG record. The Norwegian Sovereign Wealth Fund, for instance, has excluded 5 commodity firms in Q1 2025 over deforestation and corruption concerns. That's $1 billion in lost capital, gone in a headline. And what is the bottom line here? If you are not on board with sustainability, you are not just facing fines, you are risking contracts, capital, and credibility. We just explored the growing pressure from all angles, and let's look what is actually happening on the ground. How are major commodity traders and even smaller firms responding to these new sustainability demands? As always, I will start with big players, and first I would like to talk about Cargill. In April 2025, just last month, Cargill, one of the largest privately held agribusiness firms, announced a $100 million investment into methane reduction program for cattle farms in Brazil and Argentina. Why did they do that? Well, McDonald's, one of the Cargill's biggest customers, publicly committed to net zero emission by 2040 and demanded emission reduction roadmaps from all suppliers. And this is a result. Cargill had to adjust, not out of goodwill alone, but to preserve market share. This case clearly illustrates a key point. Sustainability efforts aren't always initiated by governments. Often they are client-driven and reactive. Another case is Trafigura. Nickel and cobalt, two minerals that are critical for electric vehicle batteries and clean energy tech. Trafigura, a major global commodity trader, has come under pressure in recent years for links to mining operation in Congo. The region is known not only for rich mineral deposits but also for child labor and unsafe working conditions. In response, Trafigura began piloting a blockchain-based traceability system in early 2025. This platform enables real-time tracking of cobalt and nickel from mine to market. The company partnered with Circular, a tech firm that focused on supply chain transparency. They announced that starting in the third quarter of this year, buyers would be able to trace shipments with verified ESG credentials. This shows how technology is becoming a core part of compliance. Data, not declarations, will define credibility going forward. Third example, it's companies like those in Brazil, Ukraine, and Indonesia, mid-sized grain and palm oil traders. They also have started using satellite images and remote sensing tools to monitor their farms and prove compliance with deforestation-free pledges. For example, one Ukrainian soybean trader I spoke recently with said that after losing 2 European clients over traceability issues in 2023, they invested in a third-party platform that maps land usage and cross-check coordinates against protected zones. As a result, they regained access to German and Dutch buyers within just 6 months. Tools like Global Forest Watch and satellites are becoming standard in this space. They don't just provide transparency, they help small players, small firms or small producers compete in this tightened market. Another takeaways here. Sustainability isn't something traders can add on later. It must build into procurement, documentation, transportation, and even how you communicate with clients. And those who adapt are gaining competitive advantages. Not just surviving, but thriving. So, where do we go from here? For many in commodities, especially small to mid-sized players, sustainability feel like an overwhelming thing. The restrictions, the audit, new regulation, it's truly a lot. But here is the good news. You don't have to do everything at once. Just start with something. What matters is to build a strategy that is practical, transparent, and future-ready. Let me give you a few steps to follow. First, start with data. You can't manage what you don't measure. Once again, you cannot manage what you don't measure. Whether it is emission, water usage, or labor practices, start tracking. Even a basic Excel log of your supplier emission declarations or sustainability certification is better than nothing. Eventually, aim for third-party verification. Companies like SGS, TÜV or Control Union offer ESG audit tailored for traders and exporters. Also, consider joining a sector initiative, for example, Roundtable on Responsible Soy, Roundtable on Sustainable Palm Oil, International Council on Mining and Metals. These programs not only offer standards, but also credibility in the eyes of buyer. Step number 2, clean up the chain. Most sustainability risks are hiding upstream in your raw material sources. Don't just ask your supplier for a better price. It's in past. Now ask, where is this product grown, extracted? Can you provide a sustainability certificate or satellite report? What labor protections are in place? If a supplier can't or maybe won't answer, this is a red flag. With that, consider shifting to verified sources even if they cost a bit more. Many buyers today are willing to pay a premium for traceable, sustainable goods. Step number 3. Make ESG part of the pitch. Don't keep your efforts secret. If you have cleaned up your supply chain or invested in traceability, share it in your pitch decks, your trade proposals, and especially in discussions with investors. Remember, banks, buyers, and even governments are now push initiatives, and this could mean preferential financing, faster customs clearance, and access to ESG-driven procurement tenders. It's a lot. Even something as simple as sustainability one-pager in your sales pack can signal credibility. Think about it. And step number 4. Think long-term. Sustainability isn't just about compliance. It's about resilience. As climate risks increase, from drought to floods to geopolitical instability, companies can understand and reduce their environmental and social vulnerabilities, and if they will do something, they will be better positioned to survive market shocks. In short, ESG is a rebranded risk management. So, what is the big picture here? The world of global commodities is undergoing a profound transformation. What used to be a numbers game, value margin timing, is now layered with questions of responsibility, transparency, and long-term impact. This shift is not theoretical. It's happening now. Whether it's the European Union applying carbon tariffs, investors that are walking away from dirty supply chain, or AI-driven platforms that are verifying sustainability claims in real time, we are seeing a convergence of technology regulations and market forces. But here is the key. Sustainability does not have to be a burden. It can be your edge. In industry where trust is often hard to come by, transparency is your best sell tool. And in a world where everyone claims to do the right thing, being able to prove it makes all the difference. And as we wrap up this episode here, a few questions I would like you to think about. What part of your business is most vulnerable to ESG risks? Where can you start tracking and improving today? And how can you turn compliance into competitive advantage? Because sustainability isn't a nice to have, it's your next frontier. Thank you for tuning to Circus and Circuit Unraveling Global Trade today. I'm Kate Foronda, and if you found the episode insightful, please share it with your network, leave a review, or message me your thoughts on LinkedIn or Instagram at foronda.us. And until next time, stay smart, stay strategic, and keep navigating the chaos of global trade with clarity and courage.